It's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching the China Show. I'm Annabelle Drulers with David Ingles.
Good morning. We are counting down to the open of markets here in Hong Kong. Our top stories today: oil is steadying near a 6-month high at these levels, while stocks are under pressure and growing fears of a U.S. strike on Iran.
Yeah, this is as President Trump says Tehran has up to 15 days to strike a deal over its nuclear program as the U.S. amasses an array of forces in the Middle East.
Also ahead, Blue Owl Capital restricting withdrawals from one of its private credit funds, raising fresh concern over risks in a $1.8 trillion market.
And how India's tech giants are investing in AI as the nation seeks to become a key hub. We speak to IT services firm Wipro at the AI Impact Summit in New Delhi.
Good morning. Welcome to the program. And two things top of mind, for me at least: the reopen of markets here in Hong Kong, cash markets, of course, so we'll see what happens there. Pricing while you were sleeping, not very clear as far as what the open's likely going to look like. Let's call it flat, maybe. Of course, we're looking at some specific names, but we'll get to that in a moment. The other thing, of course, top of mind for me as well is energy and oil prices, and really what this means is slow boil on the Middle East story as it pertains to Iran, and of course that pop over $70 on Brent is something I'm tracking too.
Yeah, it's kind of the risk that you wonder, have the markets been sleeping on a little bit? I mean, you've seen that premium starting to get baked into oil prices, of course, above that 70 level, but there's a lot of risks and there's really a lot of unknowns as to what sort of strike the US would look to take. Would it be something that's shorter term, more sustained? They're certainly building up a presence that could sustain something over the longer term, but then exactly how does Tehran retaliate, and in what kind of position are they, given that they seem to be coming back stronger from actions from the US last year, but also Israel?
No, yeah, absolutely. And I think what you're seeing in the oil markets, and I'll even include not just what you're seeing on spot and futures, right? So even like things like the call skew, for example, to the upside. So it looks like markets are positioning for something not so much as a tail risk, but something that we are largely within the sort of realm of possibilities. But the other thing I point out too, just so we're not sort of over sensationalizing what's happening here. As far as the price action is concerned, right, it's not as if we are getting a massive dislocation in markets and rush to safety just yet. Now, of course, headline driven, and we'll see what happens with this. There is a broad sense of risk aversion in the markets anyway, which we'll get to, I guess, in a moment. On top of that, obviously you mentioned the massive AI conference taking place in India and the conversation we'll be having there as well. A lot of news, of course, on the AI front, not to mention, of course, the two big individuals, not wanting to hold their hands on stage yesterday.
That was great imagery, I think, of Sam Altman from OpenAI, rather, and the Anthropic CEO. Just, close, but definitely not touching. Yeah. And there's a lot of concerns about the ads that were run during the Super Bowl, and of course, Anthropic's been winning a lot of enterprise customers. Yeah. Just to note as well, a story that's sort of climbing up the charts this morning is from the FT, but they are looking about this current funding round with NVIDIA, because they're looking to raise OpenAI rather, looking to raise around $100 billion just from their cornerstone investors or from big tech, essentially. But now we're hearing that NVIDIA is not going to be proceeding perhaps with that letter of intent that was signed last year that could have given them up to $100 billion investment. They're looking just at $30 billion in this current funding round. Which,
if you put the reporting together, would suggest it's still a sizable portion of the current funding round.
Yes.
But I guess TBC. What's beyond the current one, which is quite sizable anyway, as far as the $100+ billion, of course, that we were reporting yesterday. All right, let's put everything together for you as far as the market narrative is concerned, right? So we start with oil. You have Brent, you have West Texas, you have the energy complex in Australia, which was up 4% yesterday. We're sideways. We're still holding on to about these price levels, I think, fortunately, and we'll see what happens with headlines. Of course, we are not extending the gains that we had coming into this Friday morning in the Asia Pacific. Let's have a look at gold. So I think we were back above. This is spot that's coming up on your screens. There we go. It's still above 5,000. The dollar is giving up some strength after putting together a string of 4 days of gains as far as that's concerned. Some technical levels to watch in the euro. We're just now at these levels, just a touch below the 50-day moving average. Nikkei, Kospi, Oz, and Singapore. Singapore's coming online. No Taiwan yet. Today, no mainland China, no Vietnam. We mentioned, of course, Hong Kong is coming online. In fact, just on that very note, futures in Singapore on A50, futures in Hong Kong on A50 on your screens. There we go. Okay, we are looking at declines likely going into the Friday session. Dollar China on your screens as well. All
right, let's get more into, as we said, one of our top two stories today. That is the U.S. military gathering forces in the Middle East. That includes 2 aircraft carriers, fighter jets, and refueling tankers. Speaking aboard Air Force One, President Trump warned that Iran has about 15 days to strike a deal over its nuclear program.
We're either going to get a deal or it's going to be unfortunate for them. I would think that would be enough time, 10, 15 days, pretty much maximum.
Let's get more with our Bloomberg Politics editor, Laura Davison, joining us here with the latest. So it's obviously very fast moving and we don't know exactly what shape this could take, but what is the most important thing that you're watching right now?
So a couple different things. One, Trump saying 10 to 15 days. What is important about 10 to 15 days? Trump is getting impatient, and that's the deadline he set. So there's no hard and fast reason why there needs to necessarily be a deal cut in those times unless Trump says there is. And so he is kind of, right now, he's in the moment where he is preserving all his optionality. They're amassing all of these forces in the region. This is a much bigger buildup than we saw in Venezuela. So they could do, something like a targeted strike, but also, like we saw last July with just looking at nuclear sites. They could go bigger, looking at, perhaps Iranian military sites, or perhaps even target some of the Iranian leadership. That would be a huge, really change of course where this is. Trump and the White House really haven't indicated that they want some sort of massive military strike, but they want to have the leverage to say, look, here's what we could do to try to force these negotiations forward.
Okay, so what exactly, given the backdrop of recent talks, what is it that the U.S. president wants Iran to do here?
He isn't quite sure. That at least is from all the indications here. Okay. He wants some sort of deal here. He wants them to back down. He wants to also keep Netanyahu happy through all of this. So he has a lot of different pieces here. But he wants ultimately to say, look, I was able to, put the Iranian regime into submission. I was able to extract some sort of economic deal, create peace and stability in the region. That is the ultimate outcome he's looking for. And we're in this point here where we have tension between that. These details are really tricky. You've got a lot of, a lot of history and a lot of geopolitical nuance, where Trump doesn't really care all that much about that. He wants to be able to get a deal, but you have the kind of the expert level people, the technocrats, who are trying to advance these talks forwards, and Trump saying, let's just go, let's get it done, let's worry about the details later.
All right, Laura. Thank you so much, Laura Davison, there, our Bloomberg Politics editor. In fact, we're just looking at some data right now, right? We were talking about how much is baked into the oil markets right now. So our folks at Bloomberg Economics actually ran some numbers. I'm going to look at this right now for you guys as well, right? So when you look at the oil price very quickly here, so we've gone from, let's call it 10, 11 bucks on the oil price from the start of the year up until where we're at. That's the white line you see on your screens, right? So what else are we looking at here? So you have obviously demand and supply, right? How does that feed into the oil price? That's a constant feature that drives the oil price as well. We talk about oversupply. That's a net negative as far as the oil price draw is concerned. You have net demand contribution as well at the very top. Now, every now and then, you have the spikes in geopolitical risk premium that get built into the oil price here. So what we're looking at here is ever so slowly, the purple bars you see on your screens is adding to the premium. And our folks at Bloomberg Economics have put out this fantastic piece and model. At currently that level is at about $5, right? Given the information that we have right now. Now, that is just to say if all this goes away, that $5 goes away. That could also blow up to the extent we saw back in June of last year when Israel was involved in, of course, that massive spike in oil prices. But as things stand, you can check this out, of course. We're currently at $5. If you remove the tension, we go back to about 66 per barrel, but of course a lot will depend on what happens these next few days, Bill.
Yeah, I think a really big question, for instance, does Tehran look to close the Strait of Hormuz, for instance, where a lot of those oil tankers are passing through, which would obviously drive up prices. But let's get more on this now and bring in James Jeffrey. He's Distinguished Fellow at the Washington Institute, also a former U.S. ambassador to Iraq and Turkey, and advised the George W. Bush administration on Iran. So thank you very much for taking the time to speak with us this morning, James. And I want to talk about the scenarios that you're mapping out here, because as we were just saying, this is the biggest deployment that we've seen to the region from the US, going all the way back to the early 2000s. What are the different scenarios that you're mapping out, and what do you think is most likely here?
Thanks for having me on. Donald Trump wants a deal, but it has to be a real deal. It probably will have to include either no enrichment or extraordinarily tight limits and inspection of any enrichment that's allowed. That is, it has to be better than the 2015 JCPOA that Barack Obama negotiated. Donald Trump is willing to roll the dice on military actions. We've seen that repeatedly. I served on the Middle East with him in the last administration. He took out Iran's consigliere for the entire region, Qasem Soleimani, in a strike. You saw what he did to the Fordo nuclear site. You saw what he did to Venezuela. He's prepared to do this again, and he has the force to do it. He doesn't want to do it, but he will. That's the difference, and the Iranians may not get that. This is not Barack Obama they're dealing with.
Okay, what then do you think, Ambassador, do you think is the probability of some form of strike over the next, let's call it 2 or 3 days?
I don't think over the next 2 or 3 days there's a chance of a strike, but I didn't think so when he said the Iranians had 2 weeks to negotiate last June, and then he struck Fordo several days later, along with the Israelis. So right. Trump is capable of doing, Trump does not believe, and we don't believe, we who are following Iranian affairs very closely, we don't believe the Iranians really get this guy. They think they're dealing with the Americans. They think that they can just draw us out, wait for the election season to kick in. The ships cannot remain all that long on station. And Trump knows that they know that. So therefore, he's going to press them to make real concessions very quickly, or he will strike. He may do an initial strike that will be limited, but he will make it be clear that he will do a more dramatic strike. Now, in terms of the oil markets, the danger is that if he does not target the Iranian oil exports directly, I don't think the Iranians will close the Straits of Hormuz, because that will really infuriate their biggest partner, which is China. But if we do take out the Iranian export capability, their infrastructure and such, then the Iranians will have nothing to lose. And that will really have, as you folks can crunch the numbers better than I, a huge impact on the short-term oil supply.
So, Ambassador, the message we're getting, at least I'm getting from you, is for Iran to treat the threat as incredibly credible. Apart from, and I guess there's no diplomatic way of putting it, apart from having a gun pointed to its head, what motivations do you think Iran has to strike a deal with Donald Trump? It's something that we can trust beyond the current proverbial, treating the threat as credible.
David, that's a key point. The Iranian regime, having gone through the tremendous losses it suffered in what was a 2-year war with Israel, us, eventually the Turks in Syria and others, are in a very weak position. And then they had the huge uprising of their own population. Their goal is regime survival. We think that right now they believe that even taking some hits by the United States, military hits, is less of a threat to the regime survival than yielding to Washington and looking weak in the eyes of a population that's quite capable of rising up again like they did 4 or 5 weeks ago. So that's the calculation that they're making. The problem is Trump knows this, and Trump, I think, if he does go for a major operation, will go for what we call going for the head shop, taking out the leadership, and pushing the country into chaos. He's capable of doing that.
In terms of the negotiation side, the US and Iran are still divided over several key red lines. That includes nuclear enrichment, sanctions relief. Where do you think then is the most likely area for some movement forward, given we're now up against this sort of arbitrary but up to 15-day deadline?
Certainly enrichment. What Trump is trying to do, and he deserves credit for this, is to lock in and make permanent. So we finally don't have, and boy, I've been deployed 4 or 5 times to the region, so we don't have this perpetual cycle of violence that you don't see in Europe, despite the Ukraine war, that you don't see in East Asia, despite some provocative actions by China. In the Middle East, it's perils of Pauline, it's rock and roll all of the time. Trump wants to end this. It cannot be ended as long as Iran has the capability of reconstituting its nuclear threat. That's the problem. That has to go away. If it doesn't go away, he'll use military force.
Ambassador, final question. How does this, we can tend to get lost in the day-to-day and the noise. How does this fit into the broader strategy of the U.S. in the Middle East, and how does it even fit into the even broader strategy of competing with China?
Boy, you're right on target here. Trump is trying to do 2 things. He has a base, including a vice president, that are very reluctant to engage in the world, engage in military operations. But Trump wants to himself, because he knows if we don't do this, it's going to be chaos, and that will make America weaker, more at risk, less prosperous. So he is engaging. His national security strategy says we will do everything necessary to ensure no one power dominates, that's the specific word, dominates the Eurasian island. So in the end, all of this is also looking at China. He knows that if the Chinese don't believe Donald Trump is going to pull the trigger, the Chinese might risk an operation. I think President Xi said be ready by 2028, 2027, might risk an operation against Taiwan, thinking that Trump will back down. So Trump has to make sure that people understand the American commitment and the American willingness, credibility. This is something that I worked in the White House for Bush. We think about it all the time.
Ambassador, really great to have you. That was the Washington Institute Distinguished Fellow and former U.S. Ambassador James Jeffrey there. And just as we've been speaking, there's actually been President Trump posting on Truth Social, but some different commentary this morning. He's saying that the U.S. will begin releasing files relating to aliens and UFOs. Now, the background on this is that recently, President Trump has been accusing former President Barack Obama of giving away classified information on a recent podcast appearance. He has suggested on Air Force One that he could get essentially Barack Obama out of trouble by declassifying the related information around that. Barack Obama spoke about the existence of UFOs or his views around that. But we'll get more details on that as it comes to hand. Counting down, of course, the open of trade in Hong Kong. This is The China Show. Welcome back to The China Show. We are counting down to the open of markets in Hong Kong this morning. Futures are looking like we're going to see a bit of weakness at the open here. In terms of what we're going to be tracking in particular, a number of different things. You've got Minimax, for instance. We've seen more analysts continuing to initiate coverage on that stock. Hersey, for instance, one of the biggest gainers on the Golden Dragon Index in this time. We've got jobs data coming up, lots of sectors to watch, including, of course, energy, given the spike we've seen in oil prices, precious metals, given the moves as well in those. And you've also been watching HIBOR.
Yes, I think we are. This is on the 1-month rate. We're at 3-month lows in that. And, of course, after just a couple of days, we'll get an update what that looks like in about 2 hours from now. OK, let's talk about these markets, right, as we approach the open first trading session in Hong Kong, year of the horse. Joining us now is Wang, Chief EM and China Strategist at investment research firm Alpine Macro. Wang, good morning from Hong Kong. Thank you for joining us. I think we need to wait a few days before mainland markets come back online. But I just want to get your initial take. The start to the year hasn't been the brightest when you look at greater Chinese markets, at least comparatively, right? When you look at markets like Korea, Taiwan, in fact, even large pockets of U.S. equities. Why do you think explains the what explains the underperformance, you think?
I think there in Chinese markets, we don't have the super hot sectors. The sectors that have been really hot more recently, right? So, we have the the hardware tech sector, which is Taiwan and Korea, and also we have the commodity story, which is in LATAM. So in China, it's kind of in the middle. I think now for China, it's still kind of a macro call whether the Chinese economy is able to improve. I think, the Chinese stocks are still quite cheap, but there's not enough interest at this moment. The market has gone up quite a bit, but on the other hand, there's not a lot of hot stories investors can put their money to work. So I think that's probably the reason.
Why aren't there enough hot stories? I mean, we have had some cause for optimism. For instance, we've seen a wave of upgrades around AI and different foundation models in the last few days. You compare that to what you get in the US, for instance, and that's enough to spur quite a lot of trading activity.
Yeah, but if we compare with Taiwan and Korea, they clearly their hardware is very deeply embedded in the AI boom. So I think they are the more direct beneficiaries of this investment boom in the AI space. And also on the LATAM side, base metal prices have been really strong. So that has also pushed a lot of capital into that space. So I think China is kind of in the middle, doesn't really fit into both camps. But I think going forward, I still think Chinese markets should continue to move higher. I think whether China will continue to outperform or underperform, I think my view is China will likely outperform for the year because the key event that investors still need to keep in mind will be the policy choices that Beijing would have, will tell us in the People's Congress next month. So what kind of cyclical policies, what measures Beijing will have to do to really boost domestic demand? I think that is still there's still a lot of expectation going into that. So I think for the rest of the year, I still think Chinese market should do well.
Interesting, because the two meetings are coming up, I think, within the next 2-3 week window. Maybe you could be more specific, because that's largely, we know that happens every year. We know when it's going to happen. So, analysts have a lot of time to muse over what's to come. Any new information you think we might get that we should be watching out for?
I think most likely boosting domestic demand will be the most important message out of this Congress. If you, towards the end of last year, Qiu Shi magazine published an article authored by President Xi Jinping. I think in that piece, basically it's a summary of all the speeches that he gave in the past couple of years on the importance of boosting domestic demand, both consumption and capital spending. So I think in this current environment, the Chinese economy faces a lot of external uncertainty, both geopolitical and also on trade front. So I think boosting domestic demand has become the only major, untapped resources that Beijing can use to boost growth. So I think most likely we're going to see some policy surprises on that front.
We'll unpack that further with Wang. Two things I want to point out. He says animal spirits are re-emerging, number one. And when you look at the housing downturn, it's not a problem of demand on the part of consumers. More from him, from Alpine Macro, in a couple of minutes as we approach the open. Speaking of the reopen of markets here in Hong Kong, Hang Seng Tech, Hang Seng China, Dollar China on your screens. We are poised to open lower this Friday, 7/10 to 1%, specifically on the Hang Seng Tech Index.
Yeah, I think the Hang Seng Tech is going to be really closely watched, because I was just taking a look at how's the Golden Dragon Index been doing, and actually it's been lower for 6 straight sessions. So it doesn't bode that well, even though you've got some stocks that are going to, of course, be moving to the upside. We were just talking about Hersey, for instance, earlier. They were one of the biggest gainers during this period. Of course, they've also been added to index changes for Hong Kong as well. Actually, you can see already in pre-market, of course, making that jump there. Minimax Group is another one, because it's had a wave of analysts initiating coverage on it. That includes UBS, Jefferies, so more upside seen for that one as well. Oil stocks to track, of course, given all of these developments around Iran. We are seeing oil that has been moving above that $70 a barrel level, but also you're seeing these oil companies in China that are moving to the upside, and precious metals, of course, given the moves that we have been seeing in those markets of late. Again, further gains here, but you're watching the China show. The Open of Hong Kong is next following the Lunar New Year break. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down to the reopen of markets here in Hong Kong. Mainland markets remain shut, as well as some other markets across the region. We're looking at likely some weakness going into the open today. We're looking at, of course, events in the Middle East, and markets are gauging the probability of an escalation there military-wise, of course, as it pertains to Iran and the U.S. And apart from that, I can't help but think, and we're going to go over this Truth Social post from the U.S. president has a lot of the world trying to divvy up their information and attention span here.
Yeah, I mean, UFOs we can put to the side for a moment, but that has certainly, of course, been very much read in the last few minutes. Let's take a look, though, because Hong Kong markets are just coming back. This is the first day of trading for the Year of the Horse, and we're coming online to some fairly muted moves, rather, but you're seeing most of those losses so far building into the Hang Seng Tech Gauge. Now, I'm not too surprised about that because I looked at the Golden Dragon Index and I saw it had been down for 6 straight sessions. So of course, it just sort of sets that tone that we've seen really whilst Hong Kong has been shut. But you are seeing some big losses there. Alibaba, for instance, still trying to really get the nuance of that one, but it is one of the biggest laggards, off 2.8%. Baidu as well, declining more than 3% at this stage, even though actually to say Alibaba's, this is according to Jefferies, but has seen some pretty good ordering of items through the Lunar New Year break. Let's actually shift on and take a look, because we had the holiday data out of some early indications of this, and what it tells us so far is that there's been a 4% increase in passenger trips over this time. So we can take a look at some of those travel stocks, how they're faring, the likes of the airlines, for instance, also keeping a watch on what other names are doing. Can see here as well what's happening with some of the different other sectors we're tracking. So Minimax, for instance, very big gains here. Seen a suite of analysts that have started initiating coverage, and they're all pretty bullish on the outlook for the stock as well. Herside Group, we've already mentioned it a couple of times, but they were one of the biggest gainers on the Golden Dragon Index during the last few sessions. Kingsoft Cloud, though, again, it dropped around 5% on the Golden Dragon Index. You're seeing that also being reflected today. Let's change on, take a look at some of the other sectors that we're focusing in on today. So oil, of course, as we've been discussing, has been a big one. Travel stocks as well, just to wrap that up. We did see, as I said, that 4% increase in passenger travel, but you can see here those moves a bit to the downside. Going back to oil and that story there, because we've seen it steadying around a 6-month high, but a lot of questions around how exactly does President Trump proceed, given he's now set this deadline of 15 days or up to 15 days for Iran to strike a deal over its nuclear program? We have seen oil, as we said, moving to the upside, and you can see, again, those oil majors in China reacting accordingly.
Yeah, 10 to 15 days is somewhat the same time duration as the other sort of element of time that the U.S. president also favors, which is about 2 weeks. The fact that he's more specific does tell you, give you a slightly sense of urgency, I guess, in terms of his decision-making there, which was, of course, what Laura was pointing out to us earlier on. Anyway, once we do have the developments on Iran, of course, I promise you we will get them to you as soon as we can. Let's open up the outlook for Chinese markets while we're waiting for that other story to come to fruition here. Wang is still with us, Chief EM and China Strategist at Alpine Macro. Wang, the underlying thesis that you have, and we were talking during the break, was that you think Chinese consumer confidence comes back this year, and not a lot of people in the market appreciate that probability that it does. What gives you that confidence?
Yeah, so I think probably more important point would be the business confidence will come back earlier than consumer confidence, because consumer confidence to some extent was dragged down by very poor hirings, very poor wage growth, very poor labor market. So I think if in the past couple of years what we had was a kind of downward spiral between very weak household business hiring and then household demand. So both they were chasing to forming this kind of downward spiral. But I think in the past couple of months, we began to detect some signal that the business confidence is beginning to improve. I was in China during the holiday break. I was talking to some people, and also even just from the data towards the end of last year, we saw a lot of mergers and acquisition deals. So all these kind of things were quite recent. So to me, I think that's probably the more important point for us to try to monitor if indeed the private enterprises, their confidence began to improve, then the economy will feel a lot stronger. And then after that, I think consumer confidence will also improve. So then the kind of downward spiral that we saw in the past couple of years will become some kind of positive feedback loop. To me, I think that will be the catalyst for growth, for a genuine growth upturn that we can anticipate.
And how does that then also feed into the property sector? Because this has really been one of the biggest drags on consumer confidence as well, just the amount of household wealth that was tied up into the property sector. What's the relationship then that you see?
Yeah, so clearly, if the Chinese consumer confidence can indeed improve, then I think the economy will feel stronger. But I think on the other hand, the housing market, we need to realize the Chinese housing downturn has been going on for over 4 years now, right? From peak, if we look at sales, construction, housing starts, housing completion. So all these indicators in the housing market are down from like 60 to 80%. So I think in economics, nothing falls forever. So I think now we are close. Obviously, we're closer to the bottom than any time in the past couple of years. So from that point of view, I doubt this year housing will give us more negative impulse on the growth front. So for me, I think more important indicators for us to monitor really would be what kind of policies Beijing would boost in terms of the domestic demand. So to me, I think that's the key message Beijing was telling us in the past couple of months. So if this is really, if Beijing is able to do something on that, I believe the economy will feel stronger compared with in the past couple of years. So I don't think the Chinese housing market. Sorry.
No, go. Please finish your thoughts, sir.
Yeah. So I think if we look at some surveys, right? So obviously, Chinese housing demand is still quite weak at this moment. But if we read some surveys from think tanks, from the government agencies, the reasons why potential home buyers are not taking action now, are not buying, is not because there's no genuine demand. The more important factors are, interest rates are still high. They believe, maybe developers may default on their delivery. So I think all these kind of confidence and financial considerations are more important constraints on Chinese housing demand. So putting downward pressure on Chinese housing demand. But there is still if you read those surveys, people, very little percentage of people actually claim they do not have genuine demand for housing. So I don't think there's a real demand issue. This is more of a confidence issue.
Right. If I'm just racking my brain now, if I recall, the definition for demand in economic theory is not just it's both the willingness and the ability to take advantage of that, right? So from a policy perspective, then, if it's not a demand issue, if it's a, say, financing issue, are there specific leading indicators that you think we should be watching out for the overall numbers to start turning?
Well, I think there are still a lot of room for Beijing to really ease the restrict housing policies, right? So that they can begin to think about providing subsidies on mortgage interest rates, mortgage interest payment. They can further lower mortgage interest rates. So I think all these kind of things can still help to improve the affordability. And also on top of that, home prices have fallen by like 30-40% from the peak. So clearly affordability has improved significantly over the past couple of years. So I think any measure that can really help to further improve affordability, reduce the cost of owning a home or buying a home, I think that will have positive impact on really revitalizing housing demand.
Okay, you mentioned in the earlier segment that you think Chinese markets outperform this year. If all these things we just talked about now start to turn, how does that affect investment strategy and market leadership specifically? What are the best opportunities right now before it becomes apparent?
I think the Chinese market, first of all, they're still quite depressed, compared with the rest of the world, compared with historical trends. So from that point of view, there's still quite strong value proposition in the market. So to capitalize on that, I believe maybe we should hold like two segments of the market. On one hand, you want to have exposure to the high tech sector, high growth sector. On the other hand, I think we should have exposure to the deep value sector too, because I think the fact is in China there's tremendous amount of savings, and my thesis is if the market continues to go up, then the price action itself can drive a lot of savings into the equity market. And if think about it, right? So if you households they put their deposits in banks, they gain 1% interest rate. But if they like Chinese banks, their dividend yield is 4 or 5%. So I think you can still have that kind of a valuation gap that would be quite attractive for households to move money. So to me, I think this kind of almost feel like a barbell, right? So on one hand, you want to have the tech growth sector, but on the other hand, you want to have some kind of value that can be very attractive for households to attract their liquidity.
Yeah, Wang, thanks very much for joining us. Great to have you this morning. That was the chief EM and China strategist at Alpine Macro there. And there's a lot more markets coming up because we've got Vantage joining us to tell us about how investors can manage hedges against resurgent geopolitical risk. We'll have much more ahead on the China show. Hong Kong markets back for the first day of trading post the Lunar New Year break. This is Bloomberg.
Right, the other big news overnight, Blue Owl Capital. Yeah, big one here. So it says it will restrict withdrawals from one of its retail-focused private credit funds. Now, the move reverses a previous plan to resume redemptions this quarter. Let's head to New York now and bring in our private credit reporter, Olivia Fishlow, who has a story for us. And, I mean, it's the retail investor that was one of the operative phrases that caught my eye here. What does this mean for retail investors who have maybe gotten in very recently into private credit?
Yeah, definitely. It's a great question. And I think one of the main things that retail investors should be considering right now is how illiquid are these assets? Are these funds that I'm going to get my money back in? And I think as we've seen, Blue Owl has been able to return capital back, but it's just an important lesson that, these are retail vehicles that are being offered to retail investors, but the underlying loans that they hold are illiquid private credit loans.
How concerned do we need to be as well about the types of companies that Blue Owl is exposed to? I mean, one of its most notable concentrations is in the software industry, for instance, which is obviously facing quite an existential crisis at this point in time.
Definitely. Yeah, I think that obviously that is something investors are worried about, is the level of software exposure. And I think that's why we've seen actually a lot of investors look to pull money out of these funds. And it's interesting actually that, because Blue Owl did return capital to investors, and that's why they halted redemptions at this fund. And in order to do that, they sold loans from the portfolio. And the main percentage, the majority of those, or like the most type, was software loans. I think it was around like 13% or something like that. So it definitely could be viewed by some as maybe a way to kind of limit that software exposure a little bit.
Right. I mean, any specific reason why, I wonder if we're glossing over just the headlines here, why this specific fund, Olivia? And that just goes to my next question, and how this used to be just the corner of the market for, that was reserved largely for institutional investors. And I wonder then how retail investors have been recently introduced to this asset class.
Definitely. Yeah. So this fund actually is one of the earlier types of funds that were created to access retail investors. And it actually was always meant to be sort of wound down. And we saw earlier this year that Blue Owl's attempt to do that and return capital to investors was to try to merge this vehicle with another public fund. And doing so would have forced investors in this fund to take around 20% of losses. So after the news of that came out, Blue Owl scrapped the merger. And now what we're seeing is that this is sort of the new plan that they've come across to return capital to investors. So that being said, there's a lot of, I think your question just underscores the fact that there's a lot of types of funds that these private credit managers have created for retail investors. And I don't think it's really widely understood, like exactly what type of funds they are and exactly how investors get their money back, if that makes sense.
Yeah, and obviously a lot of concerns, because I'm just taking a look at the share price activity, and you're around 50% lower than you were a year ago. So, yeah, obviously a ways for this to continue playing out. Olivia, thanks very much for staying up and joining us this evening. That was our private credit reporter there, Olivia Fishlow. And let's actually stay in this space, because Bloomberg's learned that Bank of America is making a major push into private credit, committing $25 billion of its own capital to new lending deals. Sources say it plans to originate the deals from its capital markets division, which is part of its investment banking business. The move makes Bank of America one of the last major US lenders to jump into the booming private credit market. Meanwhile, Bloomberg has learned that HSBC has cut 10% of its US-based debt capital markets team. Sources say at least 6 people in New York were let go on Thursday, including one managing director and 2 directors. The bank is continuing to reduce costs after announcing a revamp of the business last October. HSBC is set to report earnings next week after its US rivals posted strong results during the fourth quarter.
Right. Let's have a look at AI, OpenAI specifically here. So the company says it has visibility into its future chip needs, even as, of course, the broader trend in the industry is an industry shortage of those things. The Chief Global Affairs Officer of the company, Chris Lahan, also told us democratic nations need to develop shared safety standards for AI.
Democratic AI is going to prevail, or if the world's going to build out on democratic AI, I do think the world does need to work together collectively to make sure you're addressing and identifying the elements that are going to be needed. And look at, we are, and I know you guys talk about this and cover this, right, in a unique and perhaps challenging geopolitical moment where I actually have some optimism in terms of where the world's going, particularly democratic world. Is that we all are going to have to work on this together. Democratic societies do need to start to develop shared safety standards on this technology. You're seeing emerging AI safety institutes, US, UK, Japan, Australia has an early version, India is thinking about an early version. And he talked about, can we think about this as some type of analog to the IAEA, the International Atomic Energy entity. But I think like those are the types of I think muscles that we're going to really need to develop to ensure that democratic AI does get built. But inclusive within all of that too is how do we all work together, particularly on the supply chain piece.
But as it stands now, do you see this chip shortage deepening further? And will that slow down the AI build out? From your perspective, how does it look?
From our perspective, I think, look, we feel confident that we have visibility onto what we are going to need. Now, we also make sure we sleep with one eye open, right? Because you want to continue the old line, trust but verify on all of this. We ourselves are working with a variety of really strategic partners who are, really supportive of us in terms of access to chips. We ourselves think about how do we impart our knowledge on chip design.
That was OpenAI's Chief Global Affairs Officer speaking with Bloomberg Insight anchor Haslinda Amin in New Delhi. And we're going to actually have more ahead from the India AI Summit on the China Show. That's as generative AI reshapes industries and governments race to set rules. We'll speak with Wipro's Ivana Bartoletti, who tells us why India is uniquely positioned to become a major AI powerhouse. More ahead. This is Bloomberg. Well, President Trump says he's directing federal agencies to release government documents that discuss extraterrestrial life and other unexplained aerial phenomenon. Now, I've got to say this was not the breaking news that I was expecting to have this hour, but it's certainly one of the most read stories as well this morning. So you've got President Trump that's gone on to Truth Social, and he's saying that the US will start to release files on aliens and UFOs. There's a little bit of nuance to this, but I think one of the major things to watch or to understand about it is that the former president, Barack Obama, was recently on a podcast where he was asked about the existence of aliens, whether they were real or not, and Obama essentially said, he said they're real on this podcast earlier this month. And so President Trump is saying that that was classified information. He shouldn't have been releasing it. And the reason that he now wants to actually make these documents public, President Trump says, is also to essentially get Barack Obama out of trouble. That's the view of President Trump. But of course, this is something that Barack Obama has also been talking about on social media and giving sort of his side of that conversation and what he said on the podcast. Yeah,
and it does seem, without having the benefit of having heard the actual statement, right, from the former president, was that the hedge, it didn't, based on what he said on social media, made it seem like it wasn't a statement of objective fact, but something that you could deduce based on the fact that it's just, space is just massive, and the probability that, we're not alone speaks to the fact that there could be actually extraterrestrial life. I can't believe we've spent a lot of time on this, but it's fascinating, I think, in some ways. Maybe just one last thing. I think we have 45 seconds before the break, and we can talk about AI later, So just the stock check, we can do that later. When you think about aliens, right, people immediately go to things that look like us, intelligent alien life, right, where it could be on underneath the surface of Europa, which is a moon of Jupiter. There's a massive ocean of water there, and we could actually find some life. It doesn't need to be intelligent life, but I guess we'll find out if they release the files.
Welcome back to the China Show. Taking a look at the Hang Seng half an hour into the session today. First day of trading post a Lunar New Year break, and we are moving to the downside here. Actually taking a look, you've got most stocks, really the vast majority in the Hang Seng index that are in the red. But if there's sort of a key theme that's developing, it is a tech-led sell-off because you've got Tencent, Baidu, NetEase, Alibaba amongst the biggest laggards so far in the session.
Yeah, and really in favor of the new economy stocks in China, right?
Yes.
We talked about Minimax and the several, not just one, not just two, but several upgrades from brokerages. on the back of that release that they had on Monday. And I think shares already reacted, I think 18 or 25% on Monday towards the close. We're up a further 6.7. I'm going to double check my stats on that as I speak. ZAI or Drupu is up 19%. So this new cohort, as you can see, and really this underperformance we're getting from the likes of Baba and Baidu, just as a proxy, I guess, to some of the other ones as well, pulling down the Hang Seng Tech Index. So I think this is a chart that's up. That's going to come later on. Let me just look at what levels we're at right now. And Minimax actually on...
It was 25%.
There we go. Okay, thank you so much.
On Monday, yeah.
On Monday. So very good day, and we're continuing that today. Nikkei, Kospi, ASX, Straits Times Index coming up on your screens. And Kospi's up again. There we go. Bloomberg Dollar Index, Dollar China, and we're coming off 4 days of strength in the U.S. currency. We are now, that's now day 5, as you can see on your screens. Dollar China 690. We don't have, of course, your pivot point today as it pertains to the renminbi fix because mainland markets are still shut. So we'll get to that later. As far as Brent and West Texas, this takes us really straight into the Iran story. And yeah, further gains, not to the extent of yesterday, but still gains nonetheless. Everything from 1 month implied vol to call skews are all also pointing to the upside, and suggesting oil markets and oil traders are getting geared up for some possibilities in the Middle East, too.
Yeah, well, what you were talking in the last hour about how much that premium is being baked in and what sort of that price is being added, and you were saying it's $5 right now. If the tensions dissipate, that $5 goes away. But there's really a lot of unknowns exactly what happens in the next 10 to 15 days. We just know that President Trump is clearly voicing impatience, I guess, with the situation right now and has put that deadline in place.
Yeah, and this massive buildup in U.S. military presence in that part of the world, right, is something that I think when you look at that escalation and the presence there alongside a premium that's been built in, almost alongside one-to-one in as far as that goes. And I think there's also a fantastic piece from our folks at Bloomberg Economics here that talks about how, as far as what the Iranians have done as far as the initial response, is they've flexed their muscles as it pertains to the Strait of Hormuz, right? So I think in the past what they've done is they've threatened the closure. They've never, to my understanding at least, they've never pushed through with a complete closure, because that would also be, of course, shooting themselves in the foot in as far as the shipments are concerned. But yeah, go ahead.
Well, no, I think that's really interesting as well, because last hour we had the conversation with the former U.S. ambassador, James Jeffrey, and he was saying, yeah, that might be an option, but it's not the option they're likely going to take. And the reason for that is that you're going to really bother China. And that's such a key relationship that Tehran has is with Beijing. So they're not necessarily going to look to react in that way, even if Tehran has been quite vocal about saying that they will respond with full force. But of course, a lot of questions around what would even an attack look like from the US. Would it be a short campaign like we saw in the middle of last year?
June, July,
would they go for something more sustained? Certainly that presence, you said the biggest going back to the early 2000s, does give them the capacity with aircraft carriers, refueling capabilities as well, to really be there for a much longer time period.
And what would that mean for the Iranian regime, where the point of the guest we were talking to earlier on, of course, was as far as their motivations are concerned, given what's been happening domestically, there is also survival of the regime, right? So something just to consider as well. Can we just very quickly, let's show that graphic up of oil. So we know where oil is at 71. And we talked about this premium that's been built in. I think we showed the graphic just to explain that a little bit further. So it's currently at $5 is the estimate coming from Bloomberg Economics here, right? As far as the geopolitical premium on top of where demand and supply and that equilibrium price takes you. So call it $66 if this goes away, assuming it goes away, if, of course, these estimates are bang in line. But just also to consider that the premium could blow up significantly in the same way it has done in recent years, if in fact these things will escalate from here.
Yeah, let's get more of that. Oil trading reporter Wang Wei now joining us from Singapore. So, Wang Wei, thanks so much for taking the time to speak with us. How are you looking at the risks in the market right now, and also that premium, I guess, and how much has already been baked into prices?
Right, so now the risk has just gotten a lot more real in the past week. We've seen the US military forces kind of piled up in the Middle Eastern regions. And the latest development is Trump, of course, giving a physical, a tangible deadline to Iran to agree to a nuclear deal. And that's, of course, a huge step up from what we have seen from the past couple of days. A lot of twists and turns in negotiations, a lot of inconclusive talks. So the increasing presence of the military forces in the Middle East is a clearest signal to the market that perhaps things could escalate. But of course, I do have to say, right now we are seeing prices in the steady territory. We haven't been seeing further increase in prices. That's because everyone's still taking a wait-and-see approach. Because ultimately, if a conflict between the US and Iran breaks out, what really matters to the physical market if there's any disruption to the Strait of Hormuz, which is a key passage for the Middle East, of course, a major oil producer in the world, to ship out their oil to buyers, especially for huge importers like the countries in Asia. So there's a lot of speculations. It's a lot of guesswork. It's unclear that if a conflict breaks out, what could be the infrastructure, energy infrastructure that could be affected, and what would be the fate of the strait.
Okay, so let's talk scenarios then. In the event we do get a military escalation, I think it depends, of course, on the type and the extent to which, but is there a range in prices that analysts are now penciling in if, in fact, we get to that escalation? And on the oversupply question, what does the fundamental story of oil look like if we were to strip out this geopolitical premium?
Right. So, of course, fundamentally, the narrative hasn't quite shifted. The oil market is still on track for an oversupply this year. But what is up for discussion really is the shape of how this oversupply would take. Like, for instance, at the recent IE week in London, a lot of oil executives have pushed back on talks about an impending surplus. A lot of people in the market are saying, hey, we've been talking about this global glut for a while, but we haven't really seen it manifest. So where could it be? And I think one hint that we are seeing in the physical markets is the buildup of oil stuck on water. So there is a huge hoard of oil that's out there floating at sea, held in tankers. And by and large, they are sanctioned cargoes, which means that only a limited pool of buyers can actually bring them in. So what oil executives are saying is that, yes, there is an oversupply, but this supply is not meant for them. So, and in fact, with more and more oil importers shifting away from sanctioned crude, there is increased competition for your mainstream conventional crude grades, which has also lent a bit of bullishness to today's oil prices.
Wrong way. Thank you. Wrong way there in Singapore for us on the oil story here. Let's bring in Hebe Chen, senior market analyst at multi-asset CFD broker Vantage Markets. Hebe, good morning from Hong Kong. Thank you for joining us here. So every time we discount geopolitics as a risk, it rears its ugly head, and here we are again talking about it. So how do we need to be discounting not just geopolitical risk, but also the potential for energy price inflation right now as you sort of map out markets?
Yes, indeed. I feel that we talk about geopolitical tension more frequent than ever. I think in the past 2 or 3 years, we have kept talking about that. Now, I feel that this is not just a temporary risk that we used to thought that it was, but now can kind of embed it into the economy whole landscape. As you mentioned, that not only that will probably limit in just in the oil prices, but the next question is what will be the impact for the inflation. I think I 100% agree with that what Long Wei is saying, that there's quite a lot of guesswork about when we're talking about geopolitical tension. Everyone are asking about what's the next. And so the market will kind of putting the risk premium. I saw that previously that market seems to putting a $5 risk premium for the oil prices. But potentially, if you're looking back into last June when the U.S. attacked the Iran Strait nuclear side, the prices even spiked above the $78. So that's sort of potential the market will price in. Whether or not they will translate into inflation, we do see that happening back into 2022. And if that's the pattern, I think that's probably the worry that we have to concerned about and pricing for the not just the oil price, energy prices, but also equity markets as well.
So how do you go about constructing a portfolio in this sort of environment if you're saying that geopolitical risk is sort of the new normal now?
Yes, indeed. I think that is a new normal. And I think rather than previously we're talking about 40-60 or even 30-70, I think that probably in moving forward under the portfolio, probably a geopolitical hedge. And under this hedge, I think that will be a part of them will coming from the resilient assets like precious metal. We're already seeing that has spiking, that reflecting this trend. Also something, if you're looking about the equity market, that will probably more selective about the particular industry or particular company that do have the resilience either in terms of supply chain or either in terms of their target market. They could bear the risk for whenever the geopolitical tension attack this industry or attack the economy as a whole.
Hebe, what's your take on this either buy America or sell America trading strategy? And I also want to get the take from your perspective on the flows you're seeing in as far as, the different products and, flow products you guys have there at Vantage Markets.
Well, I think there's a two-side of story I'm looking at that you mentioned about buy or sell America. I think they do have a particular buy. I think that yesterday the Bloomberg headline saying that the global foreign interest in the U.S. equity market is still very high, actually getting into the record high in 2025. They're showing that even the people talking about this, a bit of the diversification, the main interest still stays. And not even mentioning because the U.S. stock market is where the center of the technology development. But on the other hand, if you're looking for the currency-wise, I do believe that debasement trade that we talk more often in 2025, that questioning over the government's control of the balance sheet, that question I do expect they will keep staying and even growing bigger. In that sense, I will have taken a more bearish view over the US dollar or over the physical asset for the US. So I think there would be two kinds of view. The buying asset, I was saying that the buying American asset or equity, the high growth companies that will still continue to vet it. But on the other hand, the currency war, the debasement trade will continue to be a main trend that I will keep in mind.
One of the trends as well that we were watching this year was this rotation trade into cyclicals, defensive stocks as well. It seems like maybe that's starting to give up. And when we had the Walmart earnings, for instance, and they were signaling some caution and we saw weakness there, do you think we're going to see that bigger rotation back into big tech again?
Well, I think that will happen. And talking about you saying about the cautious, the concern over the big tech, I would say that at this stage, the market seems to more react to a sentiment scare. There is a heavy emotional discount to looking for the AI related. I saw the headlines yesterday saying that just everything but not AI. The two major concerns that we talk most about on the headlines, one is about overspending, overinvestment. That's primarily applicable to the Max 7. On the other hand, is about the AI disruption. But just looking for the overspending, the concern here, if that really translates into the damage to the profitability, we could already seeing that in the recent earnings. But instead, if you're looking for the Q4 earnings, the earnings growth for the technology sector is 30% versus only 13%, which is still a good number for the general SP 500. And the defensive stock that you mentioned, that only contribute roughly about 5% of earnings growth. So the market now is taking a view that we want to heavily rotate into the sectors the earnings only grow about 5% to 10%, and then we abandon the sectors that do the heavy lifting that contribute about 30%. I think this probably more reflect the psychological reason rather than a technical evaluation reason. So I think that's my takeaway from that.
And that's interesting that you frame it that way, that the markets, you're getting alpha from, in other markets at least, large cap stocks. And I think the phenomenon in China is you are getting the 5 to 10% earnings from large cap stocks, but the smaller alphas you're getting from, currently not as large, right? So the index push is not as apparent as, say, Korea, for example. I want to get your thoughts on, we were speaking early on with Wang and his take on his outlook for Chinese stocks, given that discrepancy between the hot spots in the market. Let's split it out, guys, please, if we can.
my view is China will likely outperform for the year because the key event that investors still need to keep in mind will be the policy choices that Beijing would have, will tell us in the People's Congress next month. So what kind of cyclical policies, what measures Beijing will have to do to really boost domestic demand? I think that is still there's still a lot of expectation going into that.
Hebe, do you think Chinese stocks will outperform as cyclicality comes back in the market?
Well, I think the Chinese market will doing well, but probably for a bit different reason from the Wang just mentioned. I think that I refer back to your point that you're saying that previously Chinese market is the big cap that carried about 5% of earning growth, but now that it seems to a shift, especially for the past 2 years, that a shifting into a technology, into the high growth stocks and companies that probably were taking more heavy lifting for this year. I think that's why I'm positive about. In terms of what Wang just saying about the policy choice here, I always have a bit of question mark here because the policy choice is something that we have talked about actually since the end of the pandemic. In the past 3 years, we keep talking about the Chinese policy could help to support the domestic demand, could support the property prices. But yet until today that we haven't seen that any solid numbers wise that showing that this really work. Maybe that's not substantial enough, or maybe it takes time. But in my personal point of view, I think after waiting for these 2 or 3 years of talking about policy support, it's probably the time to let's show us the real number before that we putting too much hope into that. That's my thought of that.
Hebe, great to speak with you this morning. We've got Hong Kong. You can see they're already 1% down as we go through the morning session. But that was Hebe Chen, Senior Market Analyst at Vantage Markets. Coming up, we're going to shift to Hello Kitty and Demon Slayer. We're looking at how Japanese moguls are turning cultural power into billion-dollar businesses. The full story is next. This is Bloomberg. Well, from Hello Kitty to Demon Slayer, Japan's pop culture is now the country's second most valuable export after cars, and it's even outpacing semiconductors. Bloomberg's been looking into the moguls turning kawaii and anime into billion-dollar empires and driving Japan's soft power boom. Let's bring in our Japan equities reporter, Alice French, for more. So, yeah, really great piece, Alice. And I'm curious for your view on the names that stand out on the list and just in general, who is making the cut as well?
Morning. Yes, I mean, if you take a scroll down the list, I think there'll be some familiar names in there. We've got the Tsuji family, which are behind Sanrio, of course, the licensor of Hello Kitty. There are some video games in there, Bandai Namco, Konami, some people might be familiar with. But what really sort of stuck out to me is actually the range of this kind of pop culture industry that Japan has really managed to build out in the last few years since the pandemic, right? So we've got the obvious ones, the IPs and the video games, but it also spreads to things like hotels. We've got Appa Group in there. I think anyone who's taken a trip to Japan recently will probably be familiar with their hotels, very reasonably priced, compact rooms there. We've even got Toridol down at the bottom of the list there, which runs these udon restaurants. We've even got 3Coins, which is sort of like the equivalent of a dollar store here, but they sell everything from sort of headphones and makeup to homeware and goods linked to those popular IP like Hello Kitty as well. So it's really kind of the range of how much this industry has been built out. And as you mentioned there, it's even overtaken semiconductors in terms of the value of exports in 2023. And I think a lot of the driver behind this is actually the weak yen and sort of the boost in tourism that Japan has seen, right?
Yeah, okay, so talk to us then about the factors behind why, this jump from pop culture and why it has created such vast amounts of wealth among, of course, the big players there.
Yeah, I mean, it's quite impressive. As I said there, of course, the weak yen is a big driver in terms of actually bringing people from outside into Japan. In the past couple of years, we know we've been getting kind of month after month of record tourist numbers. And of course, that's just helping to kind of boost the appeal of Japanese culture. But I think also during the pandemic, if we think about it, right, a lot of us were stuck at home looking for things to do. I think that's really where things like Japanese games, anime, manga sort of came into their own. I think also the companies themselves, and we've sort of seen this with even bigger players like Nintendo, they've been focusing a lot on sort of global expansion and also diversification of the products that they offer. You know, we've even seen Nintendo and also Sanrio opening theme parks in recent years, right, sort of branching out from that sort of hardware side of the IP business. A lot of companies focusing a lot more on things like social media, getting more content out there in the English language, which I think has really helped to sort of drive this boom. But I do think in terms of kind of bringing people here and for those kind of live experience tourism names, the weak yen has been a huge driver, right? And I know it's strengthened a little bit in the past few weeks, but it's still weak and it's still cheap to come here. And I think that's a trend that we'll see continuing, you know, this year as well.
It's interesting that you've got two sort of dynamics here. You've got buy Japan when it comes to the cultural icons. You've also got buy Japan in equities. And I think that, you know, it's not many people that could make a link between the two, but I think you're one of them. So what is the relationship that you see?
I'm watching.
Yeah, absolutely. I mean, look, just for example, a lot of the names on this list, the listed companies, you know, their stocks did hit all-time highs last year. Sandio's stock has been on a massive rally really since 2024, partly linked to the anniversary of Hello Kitty. But yeah, I mean, look, the strength of Japan's stock market is definitely a huge factor here, right? As you say, we're seeing this buy Japan trend really kind of exploding since, of course, Takaichi's historic win in the election a couple of weeks ago. And I think this spreads to kind of all corners of the market, not just content, but of course we're seeing it in things like shipbuilding, we're seeing it in quantum computing, we've seen it in the kind of nuclear fusion corner of the market too. And there's just that kind of like, I think a lot of excitement around Japanese equities, partly from Takaichi's spending policies, and content, I have to say, is one of the sectors that she's highlighted as well in her policies. But also, you know, we've got the backdrop of corporate governance reforms. Like I mentioned, we have the weak yen boosting exporters. And of course, you know, to top it all off, we now have this great political stability, which I think, especially at a time when things are looking uncertain across the rest of the world, Japan looks very attractive.
Alice, thank you so much. Alice French in Tokyo for us, our Japan equities reporter. By the way, you can read the full report by Alice and the rest of the team there, the billionaires behind Japan's cultural icons. That is on the terminal and also on Bloomberg.com. Right, welcome back. Some of the early movers right now as we resume trading here in Hong Kong following the Lunar New Year break. There we go. A lot of the travel-related stocks under pressure. Asia energy stocks also in focus given the up arrow story we've seen in oil the last few days or so. We are at 71, 72 there on Brent, and across the region we are getting a bid across these big names.
It's 11:29 a.m. in Tokyo. Japanese markets are just about to go into their lunch break, really setting the tone of what we see across Asian equities today. In the red, essentially, but 1.3% to the downside for the Nikkei 225. There's two different factors that we're watching in Japan today. Firstly, of course, you've got these broader macro fears. What is the U.S. going to be doing in terms of Iran? They're massing these strike capabilities essentially in the nearby waters. How exactly they're going to be acting and what are the ramifications as well? We have been watching oil, for instance, trending up to around $72 a barrel. But also locally in Japan, we had some comments out from the Japan Bankers Association that the BOJ may raise rates as soon as March of this year. So that's also just pressuring sentiment somewhat.
Yeah, it really is. And I think when you look at 155.14 on dollar yen, after well, first, I think we're coming off 4 days of strength in the Japanese currency, hence we're at 155. We're day number 5 right now. And that, I think, was because of the CPI print, which came in and lifted dollar yen even further, then pushed BBDXY into green territory, which is why we're now looking at 5 days of strength there. And just tying it back to the macro side of things. Okay, very quickly, I think we're also looking at about an hour into the year of the horse, cash market session in Hong Kong specifically. Hang Seng Tech Index did enter a bear market early this month. We did manage to bounce off that sort of 20% threshold, but with this decline we're seeing right now, in the order last I checked of about 2% or so, we have sunk deeper into that. So let's call it 21, 22% down now from the peak there. On Hang Seng Tech Index, you do have some underperformers like Alibaba, Baidu, we showed you that earlier on. Some of the outperformers like Minimax and ZAI. And the Hong Kong story has also taken some focus here because of some of the Hong Kong specific names have really been outperforming. MSCI Hong Kong outperforming MSCI China. As you can see, these property names and financials have really been punching substantially higher in recent weeks. And maybe that might be down to the fact that the economy is doing well and that you have interest rates, HIBOR, which is something we're tracking, at 3-month lows, and we'll see what the update looks like in about 45 minutes from now.
Yeah, let's also just keep watch on another big story we've had this week. That's the India AI Impact Summit that's been underway. And Prime Minister Narendra Modi's efforts, of course, to turn the nation into a major player in the sector. Just taking a look at some of the big announcements that we've had so far coming out of the event. So Reliance, for instance, that major conglomerate, says it's investing more than $100 billion in AI over the next few years. We've heard from the National Payments Corporation of India, for instance. They're saying they're partnering with NVIDIA to develop AI models. And ASML as well has been active. They're saying that they're actually talking with the government right now because, of course, we know that big push from the Modi administration has been to make chips locally.
Yeah, some of the highlights just there. What is missing, though, and I think we'll talk about this later, was that awkward moment on stage yesterday. But anyway, let's talk about more things on the ground. Let's bring in our next guest from the sidelines of the conference in New Delhi. Ivana Bartoletti is the Global Chief Privacy and AI Governance Officer at Wipro, joining us right now. Ivana, good morning from Hong Kong. Thank you for taking the time to speak with us. I mean, given the day job and your job title and your mandate, you'd be really in a good position to tell us the risk-reward of this new technology we're starting to just understand globally. So if it worries you, it should be worrying many people. If it doesn't, then that's more hours of good sleep for us, I guess. What worries you about this technology?
Thank you very much for having me. I think there are things that worry and things that excite, but I think optimism and excitement take precedence in the sense that I am quite reassured by what we have heard this week in the summit here in New Delhi. The key word of the summit has been around inclusion, has been around democratization of artificial intelligence, and I think there is an awareness that alongside fantastic opportunities that we are seeing day in, day out with artificial intelligence, there are risks, and the risks are around security, are around disinformation, are around the perpetuation of existing bias into decision-making made by algorithms, and now with agentic AI taking the center stage this year, clearly that brings new complexities from a security and architectural, but also from an ethical standpoint. But the key words here have been really about inclusion. When I'm sitting at the moment, I can see just in front of me, I can see a poster which says, for India, artificial intelligence stands for inclusion for all. And that reminds me of the key essence of the summit, which was also the key essence of Modi's speech yesterday, which positioned India as a country to do innovation with, because it combines the ability of scale up artificial intelligence and technology on a country on 1 billion people with an enormous appetite that people here in India have for innovation and transformation.
What is the capacity, though, of India really, do you think, to have a share or a say on the global stage? Because this has really looked so much like a two-horse race between the US and China when it comes to the entire AI stack.
Yeah, I mean, this is a very good point. I mean, I think India is positioning herself as a different way of doing things, which is fairly understandable if you think about, as you mentioned, the fact that we live in a world where large technology companies are in mainly two places in the world, the United States and China. What Modi said yesterday quite clearly was we are open to innovation. We have the ability to scale up. We can't produce things and then bring it to the rest of the world. So the message was develop and solve here in India and then bring it around the world. It is clearly a different way of doing things. From a regulatory standpoint as well, it's really important to note that India is positioning herself as a safe partner to do innovation with. They have adopted a techno-legal approach, which is, for example, different from other approaches around the world, which is very much around full life accountability as of any AI system. There is one point that is also very much worth mentioning, which is, yes, this has been a summit about inclusion, about democratization, about impact on the world, on the economy, but it's also very much been a summit about infrastructure, because as was mentioned earlier, AI is not just about technology. AI needs land, AI needs earth, AI needs minerals. So the investments that we have seen are very, very crucial. So companies investing in data centers, and in a country like India, where the government announced a tax relief for company investing in data centers, as well as in sea cables, as the announcement coming from Google. So it's really important to understand that infrastructure plays a key part in all of this, and this is also where India is trying to really put themselves in the race.
How much do you think, though, the comments that we get from government officials is really lip service, essentially? Because, yeah, I mean, we talk all the time about AI being a democratization force, that it has the power to be inclusive, but increasingly the way that it shapes up is that this is really just in the control of big tech that's essentially unregulated or lacks a lot of regulation, at least in the US, and this is really about just jockeying for influence and for economic gain. I mean, do you really get that sense that the governments have any sort of say in the way that this technology is being developed at scale?
Well, there are two things I believe that we need to take into consideration. One is the unicity of India, and we can't really have a discussion on this without thinking of where India stands and the peculiarity of this country. So when Prime Minister Modi says inclusion, what they mean is AI that works for India, and that means, for example, respecting the diversity of languages here. It means respecting the broad norms that are in India, so not just importing tools that come from other parts of the world, but also can be deployed and use cases that can really serve the Indian market. Now, in a country like India, talking inclusion is not just about the nice thing to do. Talking inclusion in India is also about economic growth and is about performance. So we have to take into consideration the peculiarity of India. I reiterate, talking inclusion in India is about talking performance, and this is very, very important. I think, yes, it's obviously this is a market which is dominated by large tech corporations. I mean, I think the United Nations General Secretary yesterday said it very, very clearly, and I think it's important, and this is also why many countries around the world are developing their own strategy for strategic sovereignty in particular areas where that is very much needed. I think also the investment and the Prime Minister Modi yesterday made on open source is something that is very, very relevant. What he's basically said yesterday, we need open source. It has to be very, very important, an important part of our growth strategy. And I think this is, again, one point that goes in the direction on more sort of strategic sovereign and autonomy.
Ivana, we've seen in stock markets in the last, let's call it 2 weeks or so, investors have been incredibly concerned about AI replacing wholesale replacement of sectors, right? Now I know markets tend to look at these things as binary. The reality is somewhere probably in the middle. But that list includes software and consulting services like your company, for example. I wonder, is this an existential threat for the industry? How do we need to be looking at framing this dilemma of AI as an opportunity or as a threat?
Yeah, I mean, it's clear that AI is changing the landscape, but I think what we have seen in the last few weeks is not really, it's been, as you say, a very binary reaction. Now, of course, AI is going to have an impact, and we see this, but the customer-centric approach and the fact that AI needs to be modulated on organizations and the centricity that big organizations and, for example, our clients that we work with, this is going to remain quite firmly. So of course there are disruptions, but we welcome disruptions in the sense that disruption can be daunting, but they're also a fantastic opportunity. And I believe that the entire sector that I'm part of in India, which is a sector that is coming out very strongly in this summit, I think is demonstrated that yes, change is there, but the customer centricity and working directly with large organizations, that is going to remain moving forward.
Ivana, thank you so much for taking the time to speak with us today. Ivana Bartoletti there, Global Chief Privacy and AI Governance Officer at Wipro, also out of the India AI Summit. Of course, I think Bell and I just alluded to this a few seconds back, this awkward moment, and I'm sure the world has seen this, between two of the most important executives in the sectors. Belle, why don't you give us a bit of background here?
It's great. I mean, you can just see there, okay, to the right of Modi on the screen, you can see the CEOs of OpenAI, Sam Altman, of course, and Anthropic, and everyone else is holding hands with each other, clasping hands, but those two on the stage. Now, Sam Altman is saying he didn't know what was going on and he didn't know what the plan was, but I think it certainly speaks to what is very much a professional rivalry, at least between these two, because the CEO of Anthropic actually used to work at OpenAI, and then he left it when he felt like it was becoming too commercially focused. Right. And these two companies have just been going head to head this year on a range of different releases, essentially. Anthropic, of course, has been very popular with enterprise clients in particular, and you've seen all the releases Anthropic makes. It's causing shockwaves through various industries as well. And so, yeah, maybe Sam Altman doesn't like it. Sam Altman certainly did not like the Super Bowl ads that Anthropic placed as well. Yeah, well, that was rather clearer than whether or not he actually knew what was going on stage. I think when you look at the video, he was, I think, the first one off the stage very, very quickly. And I now wonder whether humans or AI had some role in actually determining where each of the individuals were placed on stage. And, you have to give it, if this went to humans, like something maybe... there was a bit of banter, I guess, in that too, and it worked out. I think in the world, as the world unfolded before the world, as we just quite awkwardly. Whoever made that chart for the for the standing positions might have had a few words after this whole photo op went down. But anyway, we will leave that there. Of course, this moment has been going viral for very obvious and clear reasons. Look at his face. He's very unimpressed on there. All right, you can, of course, don't forget we've got this new function to show as well. It's the Bloomberg Video Hub as well. Subscribers can explore live streaming, news, interviews, all of our Bloomberg TV shows, documentaries, reporter analysis, and more. So do check it out. That's bloomberg.com/videos. This is Bloomberg. Welcome back, and here are some of the big corporate stories we're tracking today. Blue Owl shares plunged in New York. That's after the alternative investment firm said it will restrict withdrawals from one of its retail-focused private credit funds. The company says the fund will instead return capital through periodic distributions funded by loan repayments, asset sales, or other transactions. The move highlights the risks confronting retail investors entering the fast-growing private credit market. Bloomberg has learned that Bank of America is making a major push into private credit, committing $25 billion of its own capital to new lending deals. Sources say it plans to originate the deals from its capital markets division, which is part of its IB business. The move makes Bank of America one of the last major US lenders to jump into the booming private credit market. The Netflix co-CEO Ted Sarandos says the streaming giant's bid to acquire Warner Bros. Discovery will offer great value to shareholders of both companies. He says a merger would lead to more films in theatres if the deal goes through, addressing a key complaint from Hollywood. Netflix is vying with Paramount Skydance to buy Warner's studios and streaming business.
All right. We think this deal will have a positive impact on the business for the long term. Remember, what we're doing in buying these assets is we've been creating original programming on Netflix for about a decade. They've been making original films and series for about 100 years. They have incredible IP, and we just happen to have a consumer model that can better maximize the returns on that IP. So I think it's a great long-term outcome.
All right, now not coming soon on Netflix, Demon Hunters, or the sequel at least. The fans will have to wait a longer period of time for the sequel. The streaming giant finalized deals for a second movie with Sony Pictures Animation, the studio that developed, of course, the Demon slashing hit. But the creator, Maggie Kang, told Bloomberg exclusively not to expect a sequel to hit screens anytime soon.
I don't know what I will do next. I really don't. But I can't really share that at the moment. But
there's a sequel, surely.
I mean, I can't really say that officially, but I would say I would be shocked. I mean, in a world where that loves sequels, I don't think it's a surprise that something else could be coming. But I don't know. It's going to be a long wait for anything, unfortunately.
Why?
Animation just takes a long time. It's just...
Well, does it have to be animation? What about a live-action version?
I really think there's so much that the animation medium brings to the film, the tone of the movie, the types of characters that we were able to create, the type of comedy that we were able to push, the drama. So I firmly believe that the movie couldn't have seen the success if it was live action.
And you can watch the full conversation between Maggie Kang and Michelle Hussein on Bloomberg.com/videos or listen as well wherever you get your podcasts. We'll have more ahead. This is Bloomberg.
Welcome back. Here are some big headlines we're following right now. So foreign investors bought the most Japanese stocks and futures in more than a decade in days following Prime Minister Sanae Takaichi's election win. Japan exchange data shows foreigners bought a net $11.5 billion worth in the week that ended Feb 13. That's the most since November of 2014. Now, Takaichi's victory has fueled expectations of political stability and more government spending. The U.S. annual trade deficits with China shrank in 2025 to the smallest in more than 2 decades. That's as President Trump's sweeping tariffs reordered global trade. The U.S. deficits with Mexico and Vietnam widened to record levels. According to Bloomberg Economics, the effective tariff rate on U.S. imported goods now stands at 13.6%. Meanwhile, on that, Taiwan's surplus with the U.S. nearly doubled last year on a surge in semiconductor and electronics exports. U.S. data show that Taiwan, in fact, overtaking mainland China as a source of U.S. imports as the global chip-making hub grows in importance on surging AI demand.
All right, let's take a look at what we are going to be watching next week, because we have got a number of different events we're watching for. Of course, I think the big one for us is going to be mainland markets reopening Tuesday after what's been a 9-day holiday. So one of the longest Lunar New Year breaks we've seen. We've already had some indicators around passenger travel, for instance. We have seen some upside there, but at the same time, travel stocks are in the red today. And broadly, Hong Kong hasn't come back in a great position either. What else we're watching? I think the State State of the Union address is going to be really key because President Trump is already sort of indicating that big focus is going to be on the economy. He also seems to be sort of shifting his messaging around that because he's saying he's won on affordability. So that's coming up midweek, but also a range of different eco data points to watch as well.
Yeah, I think we kick things off on the 24th with loan prime rates, which, by the way, if markets were open right now, should be coming out today because it's typically out on calendar day 20th of the month. But yes, anyway, we'll stay tuned for that in a couple of days. Loan prime rates. You have the Hong Kong budget, of course, which is also towards the mid-latter part of next week. It's something to watch, of course. That's towards around this time of the day. So certainly things like infrastructure spend, housing, and the property market always features quite highly, of course, as far as the budget is concerned. And that's also to mention, and just to sort of tie those two things together as far as markets go, financials and property have been the big winners in the Hong Kong markets recently. So I think you have HSBC, really one of the big winners, will be out with earnings next week as well. So we're getting into earnings season, the thick of things next week.
Yeah, and I think just on moving away sort of from that Hong Kong improving fundamentals story, even though you've got, for instance, New World, that's going to be a really key one to track as well. But also in the tech space, I think Baidu numbers are going to be really interesting to watch because you've got that stock in the red today. They did have some announcements around share buybacks, for instance, dividend announcements as well, just a few weeks back. So how that kind of plays into the figures will be interesting, but also just because you've got so much focus on the AI upstarts like Minimax and Jipu, for instance, in the session today. How are sort of the incumbents as well faring in this space?
Okay, yeah, so I guess lots on deck as we silently fold into the weekend, and we'll see you all, of course, on Monday. Just something to watch, of course, Hang Seng Index, last hour of trade, HIBOR's coming out in the next hour. And yeah, that's it from us as we go into the weekend. I'm actually looking at aliens specifically because of the headlines that's come through this hour. But that's just me. I don't know about you. That's it from us here on the China Show. Happy weekend. We'll see you all on Monday.